The housing market you've known your whole life is now dead, as U.S. home prices are nearing record highs as inventory is dropping to record lows, with no real relief in sight for mortgage rates. Housing inventories dropped to an all-time low in June, with the residential turnover rate falling to the lowest level that we've seen in nearly 10 years. In fact, it hasn't been this hard to buy an existing home in nearly a decade. Existing home sales retreated 3.3% in June. At the same time, the monthly median sales price reached the second highest amount ever, with the median sale price climbing to $426,000. So you have existing home sales falling while the median price is spiking. And that's the primary reason why you have a lot of economists out there saying that the housing market recession has already ended. But if you watch my videos in the past, I tell you not to pay so much attention to the median price. Why? Because the median lags on the way down and it also lags on the way up. More what you should do is pay attention to what's actually happening in your market. Because real estate is local, you can have different trends depending on where you're located in the country. I'm located here in Southern California, and at the moment we're sitting on really low levels of inventory, which means every buyer out there is typically fighting over the same property, and therefore we're seeing homes sell quickly and usually over the asking price when those homes are priced correctly. And that's primarily due to the lack of supply out there in the market. It's not because we have this overwhelming buyer demand, it's just because we have so very little inventory along with enough buyers out there in the market to keep things moving forward. And that's why Goldman Sachs believes that we've got 4 more years of this housing gridlock, which I'm going to explain here in just a minute, right after I ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It shows that you not only support what I do here, but you support the channel, and it helps the YouTube algorithm push it out to more people like you. And if you like content like this, do me a favor and subscribe to the channel. So Goldman Sachs just issued U.S. home price predictions through 2026, and their forecasting model is predicting a very faint increase in U.S. home prices as measured by the Case-Shiller Index, saying that we'll see 1.3% here in 2023, followed by another 1.7% increase in 2024, along with 2.4% in 2025, and an additional 3.8% in 2026. Now, to put this in a little bit of perspective, we've actually seen an annual increase of around 5.5% per year since 1976. Now that includes the 19.1% that we saw in 2021. So that doesn't mean every single year we saw 5.5%. What it means is that some years we saw that 1.2, that 1.7% increase, while some years we saw that 19.1% increase. But once you average it out over that 47-year period of time, you have an average of 5.5%. In addition to that, Zillow's June forecast includes another upward revision for home price expectations because they believe that low inventory will continue to drive prices higher. Now, Zillow is a bit on the aggressive side, calling for a 5% increase in 2023. Now, if you've been watching my videos for any period of time, I more or less agree with the Goldman Sachs predictions, as I think that home prices are going to be relatively flat over the next couple of years. And that's because I believe that the overall volume in the market is going to be down. I don't believe we're going to see any huge decrease in interest rates. I do believe that interest rates are going to come down, but not in any real meaningful way. We're likely to see something around the low 6% range, and maybe if we're lucky, somewhere in the high 5s. But with that, we've already seen mortgage applications increase as we've seen inflation come down in addition to rates declining. So we know as rates decline, we're going to get more activity in the market. But I don't believe you're going to see a huge surge of inventory come to the market just because rates drop 1%. And that's because we have a big problem here in the U.S. housing market. And that's that only 1/10 of the mortgages have an interest rate above 6%. In fact, if you look at this chart here, 26% of homeowners out there have an interest rate below 3%, with another 45% of Americans having an interest rate between 3 and 4%. So that's nearly 71% of homeowners out there having a rate below 4%, which is nearly 3% below where we are today. And if rates dropped 1%, it would be 2% below that number, which in my eyes doesn't really incentivize a lot of potential sellers to put their homes on the market. And that's exactly why I believe the housing market, as you know it, is dead. I think we're going to have this lackluster market over the next couple of years until something changes. And at the moment, I don't really know what that change is going to be. I know that lower interest rates will drive buyer demand and will increase more activity in the market, but that doesn't really solve the real problem out there in the housing market, which is the fact that we've underbuilt housing for the better part of 10 years. On top of that, we have 2 generations back to back that will be turning prime buying age over the next 15 years, which means that you have a need for more housing out there. On top of that, we're not really building any housing in the affordable levels. And at the same time, builders aren't really building houses for the first-time home buyers out there. And you really need a market for first-time homebuyers, because first-time homebuyers help drive the market, not just in new construction, but also in existing homes. You need homes at the lower end of the price scale so that first-time homebuyers can buy them, and those move-up buyers can move up to a higher-priced home, so on and so forth. This is what drives the housing market. But at the moment, we're missing that part of the equation. But here's the thing, new construction is part of the answer. And that's exactly why home builder sentiment is rising once again in July, because they know that if homeowners don't want to sell their homes, that people are going to buy new construction. And that's why home builders are booming, and why mortgage demand for newly built homes jumped 26.1% in June. So at the moment, we know that inventory is low. We know that rates are sitting somewhere around 7% and not likely to pull back in any meaningful way anytime soon. So the next question is, what is going on in the economy? Because what happens in the economy can dictate or change a lot of different things out there in the market, as we've discussed over the last year or so. Bad news for the economy is typically good news for rates. And if rates go down, that could stimulate more activity in the housing market. But on the flip side, good news for the economy is bad news for rates. But with that said, I don't see rates really moving much higher. I think we've seen the peak in interest rates back in October of last year. In addition to that, I believe that a lot of the good news that's coming out is already built into the market out there. But what's not built in the market is any meaningful surprises to the downside. So either way, there's mixed messages out there in the market, and mixed messages create volatility. And I really think that's what we're in for over the next couple of months. At the moment, what we have is the old Fed chair Bernanke saying that the Fed is going to hike one more time this week, but kind of pulling back a little bit, saying that September is up for grabs. And that's because the labor market out there is still strong, with jobless claims dropping to a 2-month low of 228,000 jobs. But at the same time, U.S. retail sales missed expectations, but showing that underlying sales were actually strong. So all of these mixed messages out there in the economy, one shows that the economy is slowing, the other shows that the economy is strong, and unfortunately, that's exactly what the Fed is trying to squash, because strength in the economy leads to inflation. And even though we've seen inflation moderate from 9.1% last year to 3% this year, there's still a really, really good chance that we haven't seen inflation moderate entirely, and we're likely to see it actually bump up and down over the next couple of months because of how they analyze the data year over year. Now, you've heard me talk about rent shelter data in other videos, because that's a key component of the inflation numbers. In fact, it makes up nearly 33% of the number that we're seeing, and it's a lagging metric, which has been coming down over the last year, but hasn't really been reporting accurately because there's nearly a 12-month lag in that data. And we know that the rent shelter numbers are coming down as rent increases return to the pre-pandemic levels. In fact, we've seen them moderate to the pre-pandemic levels between 2010 and 2019, recording an annual increase of just 3.4%, which is significantly lower than some of the increases that we were seeing during the pandemic, as single-family median rents rose on average $470, or nearly 30% during that period of time, with them saying they don't really see any rent declines in the near term. So we know that rents are moderating, but they're not going negative. So rents are continuing to increase annually in many markets out there. And that's why I believe that home ownership is so important, because you're able to fix that monthly cost. Now everybody's going to say, hey, Jeb, you're a real estate agent. You're just pushing people to buy homes because you benefit. And the reality is, no, I don't benefit from most people buying homes. I benefit from the people who buy from me directly, which is not the majority of people watching this video. But if you're one of those people that believe that, or maybe you're one of those people that don't, just take a minute here and understand this concept. Say, for example, you're one of those millennials out there that's turning prime buying age and you're wondering whether or not you should buy a home in today's market. Well, let's just say this. Let's just say you buy a home today. In that case, you're able to fix your monthly housing costs, because in this example, you're 33 years old. You're probably in the early stages of your career. So what's going to happen is, let's say that monthly mortgage payment at the moment makes up 45% of your total monthly income. That's a lot. That's a high side, but you can actually finance that much out there with the bank in many examples. And no, that's not something I'm recommending. I'm just saying that you can do it. But again, you're probably in the early stages of your career, which means that you're going to likely make more money as you work the way up that ladder. Maybe you're getting promoted. Maybe you get another job. Maybe you just make more money because of wage growth happening out there year over year. Well, what happens in, say, 10 years is that monthly mortgage payment that was, say, 40 to 45% of your monthly income is now maybe 30% or 35%. Let's not be quite as optimistic. But what we're saying here is that as you get older and you make more money, by fixing that cost earlier, it's going to make up less of your total monthly income as you get older. In addition to that, I believe there's going to be a really good opportunity to refinance and take that rate down in the future. So not only are you going to make more money in the future, you're likely going to be able to see lower rates, which in turn means that your housing expense is going to make up less and less of your monthly budget. And that's one reason we saw all the craziness during the pandemic, is because a lot of these people that had mortgages at, say, 4 and 5% were able to refinance them at 2.5%, 3%. So it was like getting an additional $500, $1,000 a month added to your monthly income, and all you did was refinance. On top of that, most companies out there started paying more during the pandemic. So we saw wage growth. So not only were people making more money, you were able to refinance and take your monthly expense down, which put people in a much better position financially. So with that, it's not always a great time to buy a house. It's a great time to buy when it's the right time in your life and it makes sense for you.